Coming up on today's show, we're entering the Santa Claus rally. Will Santa come to town? Why these stocks gained, the economic cycle is reversing, and what it means for returns in 2025. We've got a lot to talk about. Let's roll the tape.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were very mixed, led by the mega caps and some outlier positions, but really it wasn't even the mega caps because Apple, Microsoft, Amazon, 3 of the Magnificent 7 were kind of flat here today. It was really all just semiconductors. Nvidia gaining upward of 3%, AVGO up 4.62%, but it was a broad-based rally. AMD, Texas Instruments, Qualcomm, you also see here equipment manufacturers, AMAT, KLAC, Lam Research, they gained as well. Semiconductor proxies gained as well. Dell was up 2%. And then we did see Uber hold it together for software, and then Google, Meta as well. And then we saw some bullish action here in healthcare with Tesla gaining 1.89% as well. And then other than that, it was a pretty brutal day in the market, all things considered. Most sectors lost, technology gained. In fact, the S&P 500, the second best performing among all of these sectors, it really goes to show the weight semiconductors have in these two proxies right here. Absolutely crazy. XLV Healthcare up 0.31%, and then XLC was actually pretty much flat today. And it really goes to show the bearish action we actually saw in the communication space with Google and Meta gaining. Every other stock in that sector probably fell heavily to actually see a gain of 0.8%. And then we saw pretty bearish momentum with the worst being staples. There was some big news on the staples front that really affected sentiment from 2 different points, and we're going to talk about it. We also saw real estate on the back of yields climbing, fell 0.87%, but materials, utilities, energy, industrials, financials, discretionary. It was really just a day for cyclicals, cyclical growth, and then healthcare on the defensive front. But healthcare has been a bit of a dog this year. Earnings expected to grow like 20%. I think the market's finally catching up. I've been posting a lot about healthcare. For those of you that follow me on Twitter, I actually said healthcare was my second best performing sector that I think will outperform in 2025. So I'm really looking out for healthcare. There's a lot of bearishness in there. And so I think we're starting to see that. And that's why we're seeing healthcare, really outperform, particularly in the last couple of days. However, when we look at the broader market, again, it was a pretty red day, very, very thin breath at the top. Large cap growth taking the cake up 0.7% or 0.69%. Large cap blend or large cap core right there in the mix. And then we actually saw large cap value fell 0.05%, pretty much flat, all things considered. Then we saw mid caps fell across the board, same thing with small caps. But today really was a day for value. I mean, relatively speaking, value outperformed the core and growth counterparts, except here in the large cap space. That was a bit of the outlier. So in mid caps and small caps, value was the place to be today, particularly small cap value actually being green on the day. That is stuff like regional banks, energy, healthcare stocks, biotechs. Those names are in the small value space. But all things considered, apart from like large growth, small value, pretty ugly day in the markets. And I think it's again just churn from last week, as well as some of the data we actually got today. It wasn't too encouraging, all things considered. I mean, look at durable goods orders month over month. Negative 1.1% was the reported figure. Consensus was for negative 0.4%. So a huge missing durable goods. Transport as well, negative 0.1%. The consensus was for durable goods orders to actually grow on a month over month basis. And then we also got consumer confidence, which missed by a very big way. We came in at 104. The consensus
was 113. So yeah, consumer confidence dropped here in December, and it again missed expectations by a wide margin. And this pretty much reflects views on income, business, the consumer, and the labor market. The Conference Board economist Dana Peterson noted that optimism about jobs remains strong, but future business and income expectations are dimming. Over 21% of consumers now foresee fewer jobs ahead, up from 17.9% last month. The markets reacted accordingly, and this is why there was a lot of churn under the hood in the broader market, but not so much the mega caps. Nvidia leading the charge on no news, up 3%, and this could be attributed to some of the Santa Claus rally that's starting to take shape. We do enter that officially tomorrow. Eli Lilly also came out. Their stock rose 3.3% after announcing that regulators approved Zepbound as the first and only prescription medicine for adults with sleep apnea. Zepbound is their GLP-1 drug, and pretty much if you have sleep apnea and you're overweight, doctors can now subscribe Zepbound. The stock was up 3% on the back of that, and on the back of the subpar durable goods orders, staples actually fell handily. We saw stuff like Pepsi was down 1.49%. We also saw stocks like Walmart was down 2%, but Walmart, there was multiple things at play. Maybe it was the Zepbound news, but mostly it was on the back of the Consumer Financial Protection Bureau. The CFPB sued Walmart, claiming they illegally forced delivery drivers to use costly deposit accounts to get paid. So that's going to hit sentiment for Walmart going into the end of the year, but I think it should really be short-lived. And when we look at market breadth in aggregate, today when you look under the hood, it was pretty ugly. 3,793 decliners versus pretty much 2,500 advances. But the reason why the S&P 500 and the Nasdaq 100 gained today was because the gainers right here was some of the big boys, the big names, the Magnificent Seven, and that's always gonna be a tailwind for the market. And along with this, we actually saw market averages starting to look really, really ugly. We've lost shorter term moving averages, we've lost medium term moving averages, we've now only holding the longer term trends, and pretty much this is where you start to buy the dip, especially in the broader market, in the names you like, stuff like the RSP, because it's either the bulls come in right here or we lose these longer term moving averages, and then we're in for a pretty big drawdown into the end of this year, into the start of 2025. So we'll see how things plan out. Let's hop on the charts. And guys, just before we continue, you can see right here, we are about 12 minutes or 11 minutes from the market actually closing. So, these prices are still live, at least as of recording this. You can see that the S&P 500 and Nasdaq 100, the best performing indices year to date, are 0.63, 0.79%, but then small caps and the RSP actually falling 0.5 and 0.3%. And this actually has to do with yields. Yields rose today, the dollar rose. That's going to affect small caps as well as large caps, as well as the RSP, and that's why we saw these stocks down. Mid caps gaining ever so slightly, and profitable small caps still in the red, but less so than the Russell 2000, so slight underperformance there. And then we actually saw safe havens not do that well. Gold was down, silver was up, crude was flat, Bitcoin down 2.26%. A very mixed day of trade. It neither was risk on, risk off. Based on the low volume we saw today and what we will see for the rest of the week, I think the market's just churning, digesting all of the data from last week, and really the market's probably just saying, hey, let's get through this week and then we can continue with regularly scheduled programming. But doesn't look like we're going to fall apart at the moment. The S&P 500 and the Nasdaq 100 are 0.7%, guys, as of right now. And all in all, like the majority of people hold these two indices. Like both of these have hundreds of billions of dollars in assets under management. So the average portfolio looking really good today, particularly in the US, and even for those internationally. With the dollar gaining, that means those currencies slip. That's actually a good thing for someone like me who holds the S&P 500 in Australian dollars. It means that my gain on the day is actually closer to like 0.9 maybe even 1%, all things considered. But some very positive momentum we've seen here for the S&P 500. Number one, we've actually recaptured the positive gamma zone. Very, very interesting. And you know how we knew we weren't going to fall apart? Because the put support didn't move lower. If the put support had moved lower, that would probably signal more downside. That simply wasn't the case. And that's why we actually did bounce. And that's actually why I was very, very bullish in the S&P 500. And I said to buy the dip simply because the put support didn't react the way you think it should have. And the same was true here for the Nasdaq 100. Now, we didn't quite capture the gamma flip. However, the put support stayed exactly where it is. Now, we did see a little bit of a reaction here, resistance at the gamma flip, but still a green day nonetheless. And we saw this big wick here at the bottom of the day. Really goes to show bulls came in and took control of the day, as you can see. However, this is not looking too good. Nonetheless, we do have the rest of the week to go ahead, recapture the positive gamma zone, and then we can go from there. So for the Nasdaq 100, what the stock really needs to do over the next couple of days, and I know we have a shortened holiday trading week as well as light volume, but what the market needs to do, what the Nasdaq 100 needs to do is recapture, gamma flip, consolidate. What the S&P 500 needs to do is hold the gamma flip and consolidate. If we do that, then we can get past Christmas, we can get past Boxing Day, which is the day after Christmas. We can then move higher, onward and upward, and target some of these upper levels in the S&P 500 and the Nasdaq 100. For the RTY, we still continue to see consolidation, and what the RTY needs to do through Christmas right here is hold the put support. If we can hold the put support and continue to just consolidate like we have been right here over the last couple of days, that probably means this is our support zone, and then we would target the gamma flip right there. So all the indices need to do right now is actually just consolidate where we are. Yes, we did see a gain in the S&P 500 and the Nasdaq 100, but they just need to hold these levels, recapture positive gamma, or hold the put support in the case of the Russell 2000. And then after Christmas, we can then look to higher levels and go from there. I think this is very constructive price action for us to actually see the Santa rally. I mean, if there was the day to sell, it probably was today, especially in the shortened holiday trading week, especially when you want to get risk off. Today's the day to do it for this week. And we didn't really see that. We actually saw very positive momentum in the markets, particularly the S&P 500 and the Nasdaq 100. And you could see the RSP and the IWM kind of bouncing back right now. Let's actually just go to the 1-day chart, and you can see the RSP sort of put in a low right here, and it's just had higher highs, higher lows. Now, we did have quite a bit of a gap. If we just zoom out, you can see quite a bit of a gap. So it's still technically red on the day. Nonetheless, we are sort of trading above the highs, excluding the gap, and looking very, very positive, all things considered. Great dip buying opportunity here. If we actually take a measured move, the RSP from peak to trough is up 0.93%. That's a very, very big move, all things considered. So very positive momentum in the markets, particularly from the lows when you look at it like that. And then when we look at the year-to-date chart, the RSP doesn't look that great. You can see we actually did make a lower low relative to this low, and now all we need to do is hold this 170 level. But we are actually seeing some very constructive consolidation here, and so that probably lends itself to us to go higher. We did see the dip buyers come in a very strong way, particularly at the lows, and you love to see that. You have to get nuance with some of the days we had. You can't just say we had a red day, not great. You have to look at where the markets put in their lows, put in their highs, and what came thereafter. So all in all, I see this as constructive price action. The S&P 500 needs to hold positive gamma. The Nasdaq needs to recapture its positive gamma zone and then consolidate. All of these indices need to consolidate at these key level, and then we can move higher from there. So guys, it is a shortened holiday trading week. Don't put too much risk on. If you see opportunities in stocks you like, take advantage of it. But otherwise, just enjoy the Christmas spirit. We've had a great year. We've been bullish all year. It's been a fantastic year. Let's eke out these last bit of gains and also protect our capital. And to me, that means if you see opportunities, buy the dip. Otherwise, just hold. More gains are coming into the end of the year, especially with the price action we're seeing right now. Let's talk about sentiment. This is the AAII sentiment survey. And for all of the commotion we've seen in the last week, we saw the AAII sentiment survey not really move in any material way. Yes, we did see a downtick in bullish sentiment, don't get me wrong, but we also saw a downtick in bearish sentiment. So this probably tells us that a lot of the market is still bullish, and they largely saw last week's volatility as simply a dip buying opportunity. And I think what investors are looking at is stuff like this, the Santa Claus rally. When you look at the last 5 days of the year, which we officially entered this week, and the first 2 days of next year, 7 trading days, you see really great average and median returns, 1.36 and 1.35% respectively, average and median, with an 87% win ratio. And excluding last year, the only time we actually had a loss was in 2014, almost 10 years ago. Seasonal stats look really, really good for the bulls. And that is why I think a lot of the market kind of bought the dip on Friday and are looking for opportunities to get long into the Santa Claus rally into 2025, because the fundamental picture for 2025 is strong. The S&P 500 for the calendar year next year is expected to grow earnings 14.8%, mid-teens growth. The best sectors coming from information technology, healthcare, and industrials, but we're also seeing double-digit growth from materials and comm services respectively, underperforming the SPY in earnings. Discretionary 12.2% growth, financials 9%, right? These are still really good growth metrics. Then we also saw utilities with 9%, and the 3 worst performing sectors, which normally are the worst performing sectors for growth in aggregate, come from consumer staples, energy, as well as real estate, all reporting earnings under 5%, but still positive on the year. So we should see a great year of earnings in the S&P 500, and it's broad-based earnings, guys. While we are seeing the deceleration in earnings of the Mag 7, this blue here is the Magnificent 7 at 21.3%, still outpacing the broader market. We are seeing a huge broadening out of earnings, going from 4.2% growth in 2024 to 13% growth in the other 493. So we're going to see the broadening out of earnings expand in the broad market, and earnings decelerate for some of these big companies. Nonetheless, we're still looking at 21.3% year-over-year growth. Absolutely exceptional. And this is actually why you still want exposure to these big names, to the S&P 500, to the Nasdaq 100, because the Nvidias of the world, the Amazons of the world, the Googles of the world are still growing their earnings at a very high clip despite how big they are. But if you are looking for alpha, look at the broader market, because where valuations are, this, especially if we beat earnings in a material way, you could really see outperformance from the broader market. And it's not just earnings, guys. Margins are also set to expand. Forward 12-month profit margin sitting at 13.4%, an all-time high. You love to see that. And guys, when margins are expanding and earnings are growing, stocks tend to do very, very well in that type of environment. So if we hit these metrics that we are expected to next year, expect stocks to have a really great year. But where exactly can you extract alpha? Well, according to Goldman Sachs, their model, which is just the probability of the equal weight sectors outperforming the S&P 500 by 5 percentage points during the next 6 months, they see the sectors that will do that being materials, software and services, healthcare, utilities, and real estate. So if you're looking for alpha generation, according to Goldman Sachs, you really want to be in the materials, software, and healthcare space. They expect that to outperform. For the first 6 months, Q1, Q2 of 2025, this is probably where you want to be. But that is all dependent on the macro. And we have to ask the question, is the macro favorable? And the simple answer is yes. US GDP was revised upwards from 2.8% to 3.1% here in the third quarter. Very bullish. You love to see that. At the same time, the latest PCE print showed, yes, prices did increase on a year-over-year basis, but less than what the analysts were expecting. We were expecting core PCE at 2.9, we got 2.8. We were expecting core PCE at 2.5, we got 2.4. You love to see that, and that's really great, because when you look at these metrics, right, disposable income and employee compensation, they are still outpacing PCE inflation. So we're getting PCE inflation, which is declining, right? And then we have employee compensation and disposable income, which is growing on a 1-year annualized basis at 5.8 and 5.1%. And look at the 3-month annualized, right? 6% and 5.6 versus 2.1% here in PCE inflation. So the average consumer is actually gaining buying power and pricing power against the rate of inflation. That's really, really good for the consumer. And you can see real income growth, real income expenditures excluding transfers, continues to grow at a 2.8% annualized basis, again outpacing the average cost of inflation, the average price index. You love to see that. And so with the economy doing so strong, where does that leave us in the economic cycle? Well, according to Goldman, this is what they believe. They actually say that the business cycle appears to be aging in reverse. Welcome to the Benjamin Button economy. And I'm going to go ahead and read. What does the US economy have in common with the 2008 movie, The Curious Case of Benjamin Button? The film buffs will remember that the title character played by Brad Pitt ages in reverse from an old man to a young child. The US economy is going through a similar transition, says Jared France. Instead of moving towards the typical four-stage business cycle that has defined the post-World War II era, the economy appears to be shifting from late cycle back to mid-cycle, conveniently avoiding a recession. A mid-cycle economy is generally categorized by rising corporate profits, accelerating credit demand, softening cost pressures, and a shift towards a neutral monetary policy. We've seen all four of those in 2024. Going forward, I believe we are headed for a multi-year expansion period, perhaps fending off a recession until 2028. Historically speaking, mid-cycle periods have provided a favorable backdrop for equities, generating returns on average of 14% every single year. That's based on a Capital Group analysis of economic cycle returns dating back to 1973. So a huge pool of data right here. As always, it's important to acknowledge that past results are not predictive of future periods, but if the US economy continues to grow at a strong rate of 2.5 to 3%, that could provide a healthy tailwind for markets, and growth solves everything. So all in all, it looks like we are in this mid-cycle environment categorized by rising corporate profits, accelerating credit demand, softening cost pressures, and a shift towards neutral monetary policy. And you want to hold equities in that period, guys, because we see 14% double-digit returns on average. And even moving from mid-cycle into late cycle, we can still see, a solid 8.9% returns. And we don't see recession risk until 2028, where we actually see negative returns. So all in all, hold equities, hold risk assets. The environment is favorable, particularly for US assets. Now, looking at data for the rest of the week, guys, we got a light week of data, light volume, but tomorrow we do have some big prints. Durable goods, that's going to be the big one. We also have new home sales. So the expectation for durable goods month over month is negative 0.4. That's the consensus. The trading economics forecast is for 0.3 and 0.2. So a huge divergence between the two data providers. And then for new home sales, we're expecting 650,000. And that would actually represent an 18% growth month over month. So those are the big data prints in tomorrow, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.